What's going on, everybody? It's Jeff here, and welcome back to the channel. A lot to talk about in this video as we have smashed through new lows. That weekly candle, the monthly candle closing looking very ugly. I want to talk a little bit about how the charts are set up for the week ahead and also look at some individual tickers as there is some lagging large caps. I'll cover that very closely, as well as some other metrics to prepare for the week ahead. Now, before I get into it, I do want to talk about the video I made last Wednesday. I must have stated at least 10 times in that video that it was a little bit premature. We always wait for confirmation. I've stated that numerous times. We never want to guess market direction. We wait for the levels to close, confirmation to be there before we make decisions. Wednesday's video was trying to prepare what the charts were potentially setting up to do. Clearly, that did not come out to fruition, and is another good reason why we wait for confirmation. Now, let's take a look at exactly where we stand right now. The S&P closed at new lows, SPY bouncing off that 357 area, closing at 357.18. I want to take a look at this weekly chart. We did officially close below the 200 simple weekly moving average. Now, last week, it looked like we held it. We bounced above it. On Wednesday, it looked like we were potentially going to perform a little bit of a hammer candle, get that little rally to the upside. Clearly, the bulls were just not there and did not have enough gas to be able to outweigh the bears. And they came in with a vengeance, especially towards the close on Friday. Now, it's very important to look all the way back about that August timeframe in 2020, where we do have a little bit of that choppy area. We have some support. Psychological's big 350 as well, which did remain as to the upside resistance at one time as well. Also going all the way back to before the COVID flash crash, the top of that, you do have some support as well. That next level, 350, then all the way down to about that 338, 339 area going forward. Now, a couple things I do want to mention. The first thing I do want to take a look at is the fear and greed index. We are approaching that extreme fear again. Now, let me digress, and I've talked about this numerous times, especially showing this chart right here. When one side gets too crowded, a lot of times that's when you see, retail crowding one side a little bit too much. The big funds come in and they completely smash to the other side. Market makers start to play their games. We are seeing a little bit of that. However, I do want to digress. This is not a solid strategy just to always bet against, the opposite side, because eventually you will get burned. I've said this numerous times. I'm going to say it again. Eventually, there will be no more bear market rallies. We will probably get that serious capitulation. So eventually a little bit of consolidation, a bottom will form. Things will start to change in the economy as well as with the Federal Reserve and our financial monetary system. Bottom will start to form, and we'll start to kind of see that growth starting to pick back up. But it's always good to note, if you are currently in puts, I've said to everybody, I do have long dated puts all the way out to December. I have not closed that position. I'm still carrying them, but I am very cautious in opening up some long dated puts. We are a bit extended to the downside, and I don't want to be chasing at this point, especially because the sentiment just continues to be heavy bearish. Now, going all the way back to where we were a month ago, that's when you can see we were in that neutral area. A lot of people had thought, when we were sitting at that 420, 430 area about a month and a half ago now, that listen, the bottom was in, we're going to continue to move to the upside. You never want to fight the Fed. It's something I've learned very early on. Don't fight the tape. Don't fight the Fed. It's an old saying, and it remains true all the way to this day. So keep that in mind. But like I said, you always want to be cautious when you're chasing, when these levels are a little bit overextended. Next thing I want to talk about is the month of October. Now, clearly, you do have to put into consideration that we are going through Fed fund rates rising, as well as quantitative tightening, the global financial, stress that is occurring all over the entire world, definitely puts a damper on this. However, what does the month of October look like, especially into midterm election years? Now, the month of October is actually the best month of the year when it comes to midterm elections. It is something to keep note of. If you also look at this chart, you can see where we really started to break out in August. Okay, and then about that back third end of August is where we really started to sell off, got a little bit of choppy starting into September, and then clearly just a bloodbath all the way down to the end as the 30th, which is the last day of the month, hitting that low. But it is something worth noting. Next thing I want to talk about before I get into some individual tickers, which are going to be really important, so stick around for that, is just where the entire market lies. Okay, now this is the S&P 500 index, and this is the percentage of S&P 500 stocks above their simple moving averages. And if you scroll in, you look at the 20-day, obviously it's just 2% because the last 20 days have been very, very bloody. But to zoom out a little bit further, we still have 11% of stocks higher than the 200-day moving average. Now, Michael Burry had tweeted and stated, listen, 11%, even though, we've moved down a lot, 11% is actually still quite high comparative to other situations. So let's take a look at exactly where we sit. Now, this is looking at a quarterly view. Okay, going all the way back to when they started recording this data in 2007. And at the bottom in 2008, the percentage of stocks that were above the 200-day moving average was less than 1%. As you can see, the bottom is right here. It was about less than 1%. Let's just say one and change percent going forward. Now, if you look at what happened in the COVID flash crash, same thing. We're around that 1 to 2%. So sitting at 11% of stocks still above their 200-day moving average gives plenty of room to the downside. Also taking a look at price earnings ratios, which I do not have a chart up as of right now. We're still that PE, the average PE ratio is still sitting on that 15 to 16. And a lot of people are looking around that 12.5 to 13.5 as that real value added area. Let's take a look at some of individual tickers. A couple of these are really important. I want to look at Apple first. Now, Apple is 7% of the SPY. And as you can clearly see, once we broke some of that neckline, that heavy support, that consolidation we had all the way going down into Apple, the last just 2 days, it was just nothing but blood. Apple closed it on that 147. Here we are, 10 points all the way down, really, really bringing the market to the downside. Okay, now this low around that 129, 130 area will come into some serious play as buyers will be looking to step in. Apple's, a very value-added stock. Obviously, the news coming out of their iPhone 14 issues, okay, they're going to be slowing down some of their production. I think that as these iPhones just continue to roll out as these higher sticker prices, especially with inflation running this high, they need a little bit more than just, hey, there's another camera, okay, or it's a little bit better of a camera. They need really something to change that to get those iPhone sales going. Next chart I want to look at is Tesla. Now, Tesla has a serious opportunity. I'm going to leave some of my lines up here for myself going forward, but take a look. I'll zoom in a bit for you guys, but take a look at exactly where Tesla sits. Now, we did have a little bit of this double top pattern forming, and we did have that neckline officially break with a massive wick to the upside. Now, if Tesla does continue to sell off, okay, that's where things get bloody all the way down, probably into that 246, 245 area, all the way down to potentially that 225 to 230 area. So keep this on your watch, especially for something a little bit longer dated, okay, as more of a swing play to the downside, because it's really starting to lose some of the support and it doesn't have much until you get into this area. Obviously, Tesla being heavily weighted, it will pull down the entire sector going with it. Now, one more stock just to show you a little bit of an adverse if we do get a little bit of that bear market rally is Netflix. Now, Netflix we've been playing quite recently, and it's really shown some serious relative strength. Let me zoom in just a little bit for you. Some serious relative strength, and you can clearly see from the previous two charts I've showed you that Netflix is really holding up. Okay, it's got this 255 level that I have. It's a very strong level of resistance on my chart, and we continue to move tighter and tighter until we get into that area, eventually breaking above it. Now, once we get over this 250 area, get a solid close, you've got a massive gap going all the way up to about 330. We do run into that 200-day moving average at about 300, which will obviously be another big psychological level. Massive opportunity to the upside. This is a chart I'm going to continue to watch, especially over the next few months going forward. It eventually the market will potentially find a bottom if it does throughout that early 2023, maybe mid 2023 area. Really want to see what happens. Now, if we do get a little bit of another bear market rally, Okay, Netflix will be really on my radar as it can have some massive opportunity to the upside. So, guys, I hope this video helps you out. Stay patient. Okay, don't end up chasing things too much. And that's it. I will see you in the next one.